Hello, good morning, and welcome to another episode of Hedgeye Nation, a beginner's guide. We this is our second episode, and thank you for everybody for all your questions. We've been taking just to kind of review the format. We're going to go through a few of the questions that weren't answered on the macro show this week, and then we're going to do a highlight clip of the week, and then review any of the Ask Me Anything questions. So if you got any questions, put them down in the kind of like chat below, and we'll do our best to sort of circulate through them and answer those questions at the end of the show. But first of all, I think it's really important, and we didn't do this last time, so a little bit new thing. I think it's really important to go through kind of the fundamentals. My humble opinion, this show is really about reviewing the fundamentals. So whether you're a kind of a quote unquote newbie to Hedgeye, or you've been around for years, improving and working on the fundamentals is always a huge piece of the process. And, just like any athlete, right? Coach mentioned Chris Bosch and that book today. I think, he has likely spent, Chris Bosch, that is, many, many hours working on fundamentals of his basketball game, whether that be footwork, handwork, 3-point shooting, free throws, et cetera, et cetera. So, this is really kind of, again, this show is to try to, focus on and review some of the key fundamentals within the process. And with that, Jen, if we can pull up that slide on the fundamentals. And the biggest thing here, which I've talked about a number of times, and so has Keith, and really everyone probably within Hedgeye Nation, but there's kind of like three core principles. So it's preserve, protect, and compound. So I'm going to say that again: preserve, protect, and compound. So with that in mind, you're preserving and you're protecting and you're compounding your hard-earned capital. It's really, really important to do that, and to do that across asset classes, and to have a system or sort of rules in place for what for your process, for your portfolio. So this can be different. There's an example there that Keith uses. These are his rules. I've adopted them, especially when I just latched onto them when I joined Hedgeye and found Hedgeye back in March of 2020. So just as a reminder, I was a subscriber. I've been deploying the process into my own portfolios for the last 2.5 years. And just to go down it and run through the fundies here. So FX, so that's foreign currencies, 12%. Fixed income, 10%. These are max position sizing. Let me repeat that: max position sizing for one individual security, right, or asset. So FX, 12%, fixed income, 10%, EQ, that's equities. So that would be more like your ETFs and what have you, right? So ETFs, 6%, CRB are your commodities. So that's a max of 4%. And then options would range as a max position size of 1 to 2%. Within those position sizing, you're going to have your min, your mid, and your max sizing. So you need to define those for yourself, right? If you're establishing a position, you're going to establish that min position sizing. If you're a Macro Pro subscriber, you are going to get that re-rank update if it's not out already from Keith in his long only MoFo family office, and you're going to see that he added three positions today at his min. So those were initiation positions, and he added those at his min sizing because that's his rule. Keith does not violate his rules. I think that's one of the biggest things that you can really focus on. It's something that I work on every day, and I try to improve on every day is sticking to the rules and not violating those rules. Another rule of his, and one that I've found to be very, very valuable, is if it breaks trend in either direction, whether you're long or short, you get out, right? And you close out that position. It happened to silver earlier this week, all right, and it broke trend. We were short it, and it broke trend to the upside, and we got out. So again, these are really, really important rules. But going back into the mid, and max sizing, the example on the right hand side would be for your equity ETF positions. So as a long, in your portfolio. So for instance, something like an XLE, which we've been, it's just been bullish trade and trend for quite a while, and we've been long. Max sizing would be 6%. Your mid would be 4%, and your min for Keith would be 2%. Conversely, on the short side, it's 50% of those positions. So half of those position sizing would be the equivalent of your max mid and mins. So for you, that's, I'd stick with that. So if your max for whatever reason is 8%, your max short should be no more than 4, right? So on the short side in those ETF equities. Now individual stocks, those can be again, depends on how you want to define them. It's not on the board there, but I know Keith has talked about kind of a max sizing in an individual equity or security, I should say, at 2%. So again, that's going to be his max sizing for any one individual security from an individual stock perspective, and he beta adjusts all those. So some of you might be asking, okay, well that only adds up to 30, I think it's 34%. And what that is for each individual position. So you could have, four fixed incomes at 10% max, and you got a 40% portion of your book, right? So just kind of think of those as the max, min, and mids so those there are the maxes, but think about what your max, mid, and mins need to be or should be for your own portfolio and for your own risk, risk tolerance, et cetera, et cetera. So with that, I think let's get into some of the questions here, Genron. And these are from, again, just to review, these are some of the unanswered questions from the macro show that either Keith didn't get a chance to get to or just needed kind of a bit more of a different forum, aka this forum, to review. So the first question is going to be around, shallow versus a deep quad 4/quad 1. Second question is around kind of the forecast for next year and the quote unquote no rate cut that we're forecasting. And then could you clarify whether or not whether value as an equity style factor is worth buying in quad 1? The risk range in XLE bullish but negative on oil. Can you explain to a rookie? And lastly, do you compare the change in risk in the risk range spreads to previous periods as part of your daily process? So with that, let's get into number one. What I've done is I've screenshotted and kind of captured the actual question itself. So I'll pause here for a moment. I'm not going to read it out to you, and you guys can kind of review. But this was the premise for that first question about a shallow versus deep quad 4 and quad 1. Okay, awesome. Hopefully you've been able to get a chance to get through that. Genron, can we pull up? So what I've done here is what we did, because Genron's a rock star. He went back to 2019 and he found the kind of quad map for 2019 versus what we have today. So Genron, yeah, exactly, perfect. So back in December 2019, the X and Y axis is really important and it matters, right? It matters in math. And so the X and Y axis here is 70 by 70 bips. And that's possibly one of the reasons why you're kind of, visually it's appearing as though, the quads are a bit more shallower or than they have historically. Now, the thing is though, is that we've come from, and if you go to the 2022 one from this morning, what you see there is 250 bips by 250 bips. And that's because of where we've come. This is an unprecedented time in our lives, what we saw from both a GDP growth and now kind of and inflation growth from that perspective, right? So because of that, they've gone out on the X and the Y axes, and things have spread out. So in terms of what appears as a shallow quad 4, I would say that if you really kind of dive into the numbers, that's not really quite the case. So the probability, so Genron, I think it's is it slide? No, but if we go, so if we pull up kind of the slides from the macro quarter update that Macro Pro Subs got on Wednesday, slide 13 and 15, or sort of 13 first, we can kind of review what the nowcast. Exactly, perfect. So this is the numbers that make up where the quads land on that on those quadrants and on the X and Y axes. So that'd be the real GDP growth and then the inflation expectations, the headline inflation. So what you can see here, and again, this is a sneak peek from what you get on the Macro Pro and what Keith and the team and Steiner updated on Wednesday morning. Is what you can see there that we were at a 12% growth back in Q2 of 21, and we're now casting basically 0% going into a 0% growth in Q3 of 23. So that's kind of, that because of those drastic kind of moves is why you're seeing those, basically the way that the quad map looks currently in your TMS on a daily basis. Similarly, on the headline CPI number, slide 15 there, you're seeing this big ramp from, call it 2-ish% back in late 2019, which is where we had that prior 75 by 75 bip quad model, right? So it kind of had a bunch of twos there in front of it, and then we've ramped over the course of throughout 21 and 22, early 22 to 8 and change, 8.5 in terms of the headline CPI. And now we're now casting for kind of basically that being cut in half down to 4 and a bit. So just wanted to kind of highlight that for you in terms of really this is what we're talking about in terms of obviously GDP going to zero, and the companies, Keith talked about this on the call on the macro show in terms of companies never operating in a zero GDP environment. And we'll segue into this in a minute. I forget which, but in terms of the headline inflation, excuse me, that number kind of staying sticky and elevated. The Fed's looking for a 2% rate, and we're now casting kind of just a bit over 4% in a few quarters. So that's when we say kind of a disinflationary environment. That's what we mean. It's going to be going down, but it's going to remain elevated from a historical standpoint. Question 2. See, I had a feeling I did this properly, Genron, right? Putting the segue from headline into the no rate cut. So this is exactly right. So, is your forecast no rate cut next year? So I'll let you read that, but basically, the short answer is yes. And here's why. As I just kind of mentioned on the prior slide, headline inflation is going to kind of stay elevated, but you're also seeing the data coming out from the bond market, and it's basically the implied policy rate and the number of hikes / cuts per period are there on the screen there, right? So we're seeing kind of an elevated range going up. Again, what the market is telling you is a hair under 9% by the summertime, call it in May, June timeframe, and then staying elevated throughout the rest of 2023. So when we were saying kind of no rate cut and an elevated higher rate of rate of a Fed rate, then this is what we're looking at. This is kind of a portion of the data that we're seeing. And then when you compile that with sort of like the CPI and where we expect that nowcast to be, and the fact that the Fed, which Danielle DiMartini Booth was very kind to make an appearance in Dallas last week. She and Keith ran through kind of certainly her expectations of what Powell is intending to do, and the fact that we're also now casting an elevated inflation number of basically significantly higher, almost double what the Fed would like to take the inflation rate of 2%, and as a result, the rate cuts. The probability there is low, and then you're also seeing this the yield curve, right? So the yield curve in and of itself is something that you should be paying a very, very close eye to, and it really should be right on your watch list, right? So you should within the fixed income market or fixed income space, you should have kind of like we rank them in the risk ranges. You should have the 30-year, the 10-year, the 2-year, and then the 2s minus 10 yield curve. So that's from the TMS macro deck that you get every morning. We update that on a day over day, week over week, and month over month basis. Make sure you're tracking those numbers, because it's going to be it's helpful in terms of having you understand kind of the rate of change of those basically of what's happening inside of the U.S. Treasury, and that's going to influence not only the depth and breadth of the recession that's on the horizon, not only from an earnings profit recession, but just from how bad this recession could be, and the fact that elevated rates, what we haven't seen in a very, very long time, and what that could do to across the board again. So Another subscriber actually mentioned, so this was Steph from France. Yeah, they asked about the lack of expected rate hikes, and as I just mentioned, the difference between Hedgeye and Old Wall, who's begging for a cut, and bidding up growth to low no cash flowing companies in the last week. So Generon, can you pull up the chart that we put in TMS as well in terms of the expected cuts right now? I believe it was at minus there you go, minus 38.39. So again, this is kind of one of these things where we are different, or we're positioning our portfolios differently from what the Old Wall is kind of like begging for, right? The Old Wall is begging for a cut, and that data, or you can see that in the numbers. They're currently saying, okay, we don't think maybe Powell is going to either stay flat here or perhaps even cut at this next meeting. We just don't think that's correct. And so we're taking kind of the I guess opposite view of that, right? Where we're certainly where we're short growth, and we're short companies with very poor balance sheets and poor earnings. I'll leave it at that. Next question. Awesome. So the third question here, clarify whether value is a buy in quad one. Keith's mentioned a few times over the last few days, certainly on the call, I believe it was on the 15th, about quality and value, and how they play can play a good role in terms of your exposure inside of your portfolio. As you see in the risk ranges, if you get that product, XLP, XLV have been added over the last couple of weeks. They've been bullish, trade and trend. And with that, so again, these higher quality companies, the higher quality companies with really strong balance sheets, with a great visibility into their cash flows, their earnings. These are the companies that we want to kind of have in our portfolio, right? And in the last this week alone, I think it was on Tuesday, some of the top signal strength stocks, might have been Wednesday, but some of the top signal strength stocks from Keith that we've been reviewing are stuff like Humana and Walmart, McDonald's. These are kind of companies with very strong, as I said, very strong visibility into their earnings, and either have weathered kind of the quote unquote kind of storm already, right? Like Walmart had their inventory build that they've sort of gotten through, and McDonald's is kind of doing sort of value deal menus via their mobile app, et cetera, et cetera. So there's a lot of different reasons why we like these companies, or why fundamentally, these stand out. But really at the end of the day, it's about the signal. But if you are curious about, learning more about any of these three in particular, Tom Tobin's our healthcare analyst, and the consumables team with Powered and Belosi, they cover both Walmart, Mickey D's. But there's a number of very high quality, strong visibility. FedEx was mentioned the other day on the call as well from Jay Van Sciver. So there are plenty of longs that we have. I think the last list on Wednesday that I saw from Keith was a list of 23 companies that we cover, individual names that have strong signal strength and fit basically this kind of profile. The other thing too, just to kind of keep in mind here, is the again, and this was part of the kind of clip of the week, which is one of the reasons why I wanted to review it. But we're squarely in the chop bucket. That VIX risk range today was call it 22 by 27.5, 28, and that's clearly in the chop bucket. Chop bucket's 20 to 29. And equities become investable, or more investable in that scenario, and you're seeing that from how Keith is positioning his portfolio. Adding to ETF Pro just this morning, where he added gold, GDX, and platinum. So these things, again, this is a kind of this regime where quad four, we have quad four for the next couple of quarters, and then quad one is on the horizon as well. When you're looking at kind of the back tested information, General, can you pull up the quad kind of not that one, sorry, the one from TMS where we list all four of them out? Apologies, we'll get to that one next. Yeah, perfect. So I know many folks kind of can anchor on this, maybe probably I'd say a little bit too much, because this is only really a portion of the kind of asset classes or factor styles that one we have backtests on. And if you're a Macro Pro sub, this is portion of the macro themes deck that you get. There's an entire slide, I believe it's slide 7 in that themes deck, so go review that. But the great thing with that is that it lists out all the expected values from everything from the basic quads. So the quad, as you see here, quad 1s, 2, 3, 4s, but also for various degrees of GDP change, whether it's shallow or deep, Fed policy, easing, whether it's on hold, tightening, and then what was the prior quad regime, right? So there's, we back tested a lot of different ways for the various factors, and we actually list out the expected returns, the expected values, quarterly expected values. So what you see here is kind of like, we kind of put together the top, the top performing, right, for the longs and the kind of shorts. But the other flip side of that, though, is that there are like for every positive that, in terms of number of times. So let's just say hypothetically, it's 65% of the time it's positive in a quad 1. You've got 35% of the time it might be an underperformer, right? So an outperformer, an underperformer. So if we go to that slide that you just had pulled up, Jen, on there, what I did was I kind of took a snapshot as to the expected values in terms of by quadrant for both value and quality. So in quad 4, what you can see is, quality, back test as kind of a, negative 30 basis points versus a negative 1.4% on value, or sort of the IWD versus the QAL. Those are both kind of the ETFs. Whereas in quad 1, you get a plus 6.9% for quality and a plus 6.3% for value, right? So, when Keith mentioned sort of, basically he was really harping on quality, and he has been for the last couple of weeks, to be perfectly frank. I know he did say value, performs well in quad 1 on the call on Tuesday morning. And it does, right? It's a positive. Now, if you go kind of look at that board and you kind of look at the other numbers there, stuff like momentum and cyclicals, they might outperform, from a back test standpoint in regards to the actual, number itself. But that doesn't mean that quality and value don't actually put up positive returns in a quad 1 environment. And then lastly, with that in mind, the signal is really going to guide us. And also we're in a very unique environment here, as we just, as I just mentioned, in regards to where we're coming from a GDP standpoint, headline inflation standpoint. So, every cycle is different, right? So the signal, as I mentioned, is going to really guide you in terms of where you want to position your portfolio and what kind of factors, exposures you're going to want to have inside of that portfolio. So I think that's really the biggest thing to keep in mind, but hopefully I've answered that kind of question. Oh, the other thing too, from a prior quad 4 environment, the expected value for expected values on a quarterly basis for value is plus 8.5%, while quality is plus 8.2. So, again, when we're coming from prior quad 4, those do perform well and have even, better back tested returns in that regard as well. The signal always guides the way, though. And another good segue here, bullish XLE, but bearish on oil, and why. So let's explain it to a rookie. And really, at the end of the day, it's pretty straightforward. It's just the signal. The signal kind of guides us. That's the short answer. Keep it simple. I like to keep things simple. And really, so XLE is bullish trading trend. Oil is not. But the reason why I kind of wanted to answer this question was a bit more because I wanted to, I fielded a lot of whys lately. There's been a lot of whys in regards to, why is gold, up, right? Why is the dollar down? Why is, a lot of whys. So I'm going to just kind of try to help save you a lot of time. And I know it has saved me a lot of time, a lot of anxiety, and has improved my performance. And that is if you just let go of the why, just let it go. As, as Elsa from Frozen would say, let it go, and focus on the when and the where are absolutely critical. When to act, where to execute. This is really, really important. That's kind of the two key things here. If you kind of can keep things simple and you act at the top of the risk range, in an asset class or in an asset itself that's bullish trend, bullish trading trend, that's where you can really perform well, and you kind of keep things simple. You keep things, just pretty straightforward. So the other thing too is that you can sell some, at the top in the range, and you buy some at the low end of the risk range. Sticking with those rules for position sizing and incremental buys and sells, I think you're going to be very successful with the Hedgeye process. And you do the same thing with the shorts, except it's obviously focused on, assets or inventory with bearish trends. So if it's in a bearish trade and trend environment, you're going to sell some at the top of that range, and you're going to buy some and then cover some at the low end of the range. So again, not to keep things super simple, but that's really at the end of the day how I try to execute. All right, next question is around comparing the changes in the risk range and the spreads from previous periods. So I'll let you guys kind of read that through there in a minute. And at the end of the day, the answer is really kind of, right. So it's it's a bit tricky, but it's basically kind of, and I think, most folks understand that the race ranges are dynamic, and they'll shift with with price, volume, and volatility. So when those things change, the risk range changes, right? So we have volatility move from 24 to 30, those risk ranges are going to drastically, they're going to shift, right? So, in that environment, the low end of the risk range on, say, the S&P is likely going to move lower, and the top end is going to come in, right? Or come down. So, but the same thing, right? So if price shifts, right, all of a sudden S&P, like we had a day last Thursday where, we were up 7%, those risk ranges are going to change. I think for me, what I do when I look at those risk ranges, I'm assessing the day over day, changes, as well as the week over week ones, right? So on a day over day basis provides me a good reference point as to where we've come from. And what kind of, what data may have influenced the shifts in the range over the last 24 hours, like once the VASP kind of signal gets digested, or once those data points get digested by the VASP, and Keith kind of, updates things in his side of his risk range. So that gives me kind of a day over day, right? So like, again, like from last Thursday to Friday, how did the range change? On a week over week basis, that helps me, look at things a slightly longer time frame, and helps me adjust or kind of anticipate, or sort of get a better sense, if there is any sort of Brownian motion, right? So if things are only up, 2704 to 2709 on the low end, and 3212 on the top end at 3215, right? So like on a day over day basis, that's Brownian motion. It's aka not a whole lot to read into. But on a week over week basis, maybe that low end was down at 26 and change, and the top end was at 29 and change, right? So we've had a big move over the course of the last week. And so that to me is something to be really be paying attention to. So if you wanted to take an example from today's risk ranges, we had a couple big lower lows and big lower highs in crude oil, and then conversely, we had some big higher lows and big higher highs in the gold risk range. So go take a look at those and look at what that looked like, basically day over day, as well as week over week. So this time last Friday, and then this time yesterday. The other thing too, just to note, obviously from a widening range, so the comment, the question was really about kind of a widening range, and what to sort of, I guess, maybe read into from that. And the volatility. So again, like all those factors, price, volume, volatility, can influence the, how the risk range appears. But a core one is volatility. And I've heard Keith say this a number of times on the macro show. A widening range equals an increasing level of volatility, especially kind of likely on a vol basis within that asset. So again, if vol is coming out, so he's talked about this, I think, last couple of days, or certainly this week, where if vol's coming out of the asset, things are kind of contracting. right? But if a widening asset or widening risk range like the U.S. Treasuries, right? So the 10-year, for instance, that's been a very wide risk range the last few days, and we've seen the move go from bouncing off kind of like the trend line down at around 113 and moving up to 132, right, as of yesterday's close. So an increasing volatility will widen those ranges. And then the other interesting thing too, or not interesting, I don't know, I mean, just something to note is a tightening range often, as I said, is a decreasing level of volatility, and lower vol, or kind of lower volatility with an asset as it's kind of coming out of that asset. Fund flows typically move towards those types of assets, right? Especially ones that are in bullish trends. So if you get if you're looking at an asset class with a in a bullish trend with sort of a compressing risk range, that's a really nice setup to it kind of basically putting in kind of it's compressing, you're picking it up, hopefully you're buying some at the low end of the risk range, you're staying patient there, and then it should hopefully continue up in that bullish trend. But again, just kind of keep that in mind in the future. So with that, I think we're on the clip, right, Genron? Awesome. Yes. So we're going to pass over. So so you're going to see a clip here. I believe it's about a minute and a half of Keith reiterating the setup and sticking with the quad. If you're looking for this clip, it was from November 15th, the macro show on November 15th, about the 27.5-minute mark.
I'm going to reiterate that it's not about inflation anymore, Zach. Everybody knows. It's all there. Look at it. Slide 15. We have a higher, it's going to come down less fast from here, CPI. It's quad 4. So we've already, yes, inflation's yesterday's news, Zach. The future is the global quad 4 recession, where the rate of change in corporate profits goes from currently up 3, X energy, it's down 3, to -5, -10, -20% in the next 2 quarters. That's why if Zach buys a basket of YOLO call options today at the top end of the range, he's going to get impaled. Because then he's got to deal with all the companies reporting Q4 and Q1 earnings in this environment. Right? So that's the next part of it. It's everyone's going to be body bagged by the next thing, including eventually the Fed. Right? Because they're going to stay hawkish the whole time because inflation's not going to come down fast enough. It's already come down enough for people to believe and want to need to believe that it's quad 2. Bring it all back. I need it back. When in the meantime, you should be long Walmart, McDonald's. We talked about FedEx today. Again, on the call, you can get a good sense. Defense stocks, lots of the things that we own are going to do well in that environment because they have visibility on earnings and cash flows, whereas cyclical growth and or outright cyclical growth that has peak pricing from peak inflation embedded in their former revenue highs are going to be the biggest losers in the down cycle.
Yeah, so hopefully, you enjoyed that clip. I thought it was really important this week. We've kind of touched base on a couple of different components there. And again, a lot of the questions I think are surrounding that kind of concept and idea. And what I'll say too, I'll reiterate this. I think it's really important to remember that, if we get back up into the F bucket north of 29, things can change from an equity standpoint, right? So you're going to be wanting to kind of gross down some of that equity exposure. But for right now, we play the game that we have in front of us. And that game is squarely in the chop bucket. And it's and yeah. So play the game in front of you. Coach kind of mentioned that today as well on the macro show. With VIX in a chop bucket, we've got the kind of ETFs and the individual names that we definitely like, right? That work in a quad 4 environment. And we're just going to kind of keep putting those into the portfolio, right? Buying them at the low end of the range, selling some at the top end of the range, and just kind of staying in front of us in terms of what the game's presenting on an everyday basis. So with that, when I was looking at the arena earlier or last night and even this morning, there weren't a ton of questions, or some of them were a little more kind of similar to what I was going to be going over today. But Genron, did anything kind of pop up into the arena while I was talking? And I did have a little bit of a thought. So we have time for one or two live questions is what Eric is telling me, Generon. So I don't really see those, but maybe I can pull up the arena real fast. 1 second, guys. See, this is what we do here on live. We're doing it live right now. Let me scroll through. Here's one on trade and trend lines. So trade and trend lines, fixed, aka not dynamic, unlike the risk ranges, which are dynamic. So that's a good question, and the answer is no. Everything everything is dynamic. But so again, what I'll do, because that is a pretty I guess nuanced math question. So what I will do is I'm going to kind of like circle back with Keith on that and kind of get some of the key influencers of what influences from a data standpoint, from the price volume volatility, if anything's sort of like weighted slightly differently, what have you. But long story short, and the way that I've certainly, I guess, viewed the trade trend levels is that they are a reflection of kind of a combination of the price volume volatility, right? So, think about if we've come from a, high level. So let's just use the S&P, right? So the S&P, we had those high and high prices from August. Those are just kind of looking out of the look back window right now on a 3-month basis. Now, again, I don't know how far back Keith goes in terms of his look back, but let's just use 3 months as an example here. As those pricing start to shift out of the look back, that's one factor inside of that model that might have the trend line kind of step down a little bit, right? So it'll step down to kind of a bit of a newer plateau. And then as those pricing start to kind of keep down, so if you pull up that S&P chart, you can kind of see, how the pricing sort of trended lower. And then volatility has also come out as well over the last few weeks, right? So just keep that in mind. So long story short, trading trends are absolutely still dynamic and they do shifts. So when Keith gives you a trade and trend line, that is not something that is in perpetuity. They do adjust on a daily, regular basis. So, we're coming up on the 40-minute mark. What we might do, let me see if there are any other good ones here. Great to see you in Dallas. It's been higher in Green Day, so volume. That's actually a good question. Let's finish with this and then we'll wrap up. We'll keep it to tight 45 minutes. So how should we be thinking about volume lately? It's been higher on green days and lower on red days for the major indices. Second one, how should we think about big eyeball discounts, massive downsides on these some of these indexes? So good question. I think the volume, again, the way that I approach it, this was from Justin. So Justin, just review the data, right? Again, it's not totally a why question, but it's just sort of how do you think about it? And basically the volume impacts, as I said, go back to kind of the price volume volatility standpoint, volume is one of the key pillars here. So it's absolutely, you're doing the right thing in terms of, keeping track and watching that volume. I think what you can do on if you're kind of, looking at certain, pieces of inventory or assets, you can kind of have your different volumes. Most of your brokers should have basically kind of like your intraday volume. So comparing kind of we're about 3 hours into the day. So kind of what volume has looked like on, say, the S&P SPY on kind of like a 3-hour basis on the last month or what have you. So that's definitely things that I have tracked or that you track, right? So it's kind of average volume on if you kind of look at the the macro show, slide, it gives you day over day, 1 month and 3 month, I believe it is. So, but basically, track whatever volume you get from your broker. Those are really good things to have up, right? So kind of not just look at like the day over day volume, but look at the kind of average from the last sort of, 1 month, use our trade trend lines, right? So, 1 month, mine doesn't have 3 months, but it has 6 months. So I kind of incorporate that, right? So just kind of keeping track of that volume on various kind of stages of kind of the like I guess the look back. But in terms of what we're seeing here lately, I think just do it, just do what is right. Play the game that's in front of us, as I said earlier. And what you're really seeing is volume coming in. Basically, people are kind of capitulating on green, right? So the volume's kind of coming in, and folks are so worried that this is the bottom, and on red days they're just kind of disappearing, and they're trying to figure out what to do. So we're in a really good place. I think stick with the process, stick with what the data is telling us, and we've been very happy so far in 2022, and for many quads before that too, right? Hedgeye has been around for a long time, and Keith and the team here, we kick ass. So just keep at it. It's best research around, and we're here to help. So hopefully you guys had another good episode here of a beginner's guide. Where the next one we'll do will be in December, so after Thanksgiving, and maybe we'll do a little bit of a different. Anyway, I'll sort it out, but looking forward to it. If you got any questions, the arena is a great place to put out questions, whether it's kind of process oriented, and you can either tag me or the Hedgeye Nation is an incredible group that really helps bring people together and supports each other. As one of the biggest takeaways, certainly at Dallas and all the regional events and Hedgeye Live, is just the number of folks that care deeply about this process, care about just being accountable and trustworthy, and is really, really important. And so yeah, we'll leave it at that. Thank you, and hope everyone has a great weekend.